Hello, everyone, and thanks for logging in to see this short talk. My name is Alex Lucas, and I am the Vice President of Community Impact at Member One Federal Credit Union, and I'm honored to be a part of these talks. Today, I was asked to participate and share a little bit about my expertise. I'll admit that that's a little bit limited as it comes to specifics for complicated finance. In fact, I need to put up a disclosure here, let people know whenever I do these financial education sessions or similar type talks that I'm not a tax attorney, I'm not a financial advisor, I'm not an accountant or any type of uh, legal representation or investment advisor. So just keep that in mind. My expertise has to do only with education and with financial counseling. I am a certified financial counselor and I am a financial educator and have been for the last 10 years or so as a part of Member One. I originally was a school teacher. I taught high school and middle school for about 20 years, well, 17 years, and made the switch whenever I realized that the things that I wanted to teach were things that are more impactful. And I sort of figured most people's problems have to do with their money. And so why not spend my time as an educator being a part of an organization that supports community through financial education? So thank you for again listening. I'm honored to be here. And today, just some simple thoughts about banking basics. The primary goal today, I'm just going to get quickly through a few key ideas about banking and maybe give you some food for thought and maybe some fodder for conversation during the event upcoming. So let's get started. The very first thing I want to share is a specific differences between the three primary financial institutions that I'm going to talk about. Those are non-banking financial institutions, or NBFIs. I've heard people call them NFIs before, banks, and credit unions. Now, there are different types of financial institutions that keep popping up, lots of different ones. You might have heard the term fintech, that's financial slash technology company. You might have seen some technology being used that does banking type things like Zelle or PayPal or Cash App or Venmo, things like that. Those are sometimes backed by banks, sometimes not, and their structure and organization is so new it's probably going to take a little bit of time to look them up and to see how they're actually organized. Just very quickly, non-banking financial institutions, or NFBIs, or sorry, NBFIs, are things that you might see that do specific transactions but then charge fees for them. Banks are those for-profit institutions that offer deposits and loans, and credit unions are not-for-profit organizations that are member-owned and operated. And I'll talk a little bit more about that for some specifics. Start with the most common one, banks. Whenever I say, hey, I'm going to the bank, most people would understand what that means. A bank is a for-profit institution that has a license to receive deposits and issue loans. So they're about money movements. Actually, all three of these, and also the fintechs and other online businesses I talked about, are about moving money. They're transactors. They do transactions, and that's the business that credit unions, banks, and NBFIs are in. As well as there's other companies I talked about. They earn money by moving money. And banks, those for-profit entities, sometimes they're publicly traded. They can be privately owned, but sometimes they're publicly traded. They have stockholders. They provide banking services for profit, and they have customers. Credit unions are not-for-profit organizations, and I'll let you look up what that means. It's not the same as a nonprofit organization. Credit unions do generate income, but they are member-owned and operated, and they are required to return that income to their membership. Non-banking financial institutions are services that still transact money in some capacity, and you might think of them as sort of those check cashing businesses or businesses that do individual money services for exchange of fees. So, for example, you might see a business at an airport that changes international money to United States currency, for example. That might be considered an NBFI. They'll do that for a fee. It's not really a bank. You don't really have an account at that service, but they still provide a money transition or a money transaction service. A check in the cash place, you might get a paycheck, or a member or customer might get a paycheck and go to a check in the cash place or a check check cashing placed in order to cash that check. They might bring their paycheck and they charge $10 to cash the check or something like that. Charging a fee like that is not an account. It's not the same as a bank, and so that is often considered an NBFI. Non-banking financial institutions, we're not going to get into much, but basically they don't operate in the same way that banks do. They don't have deposits. They don't have loans. Typically, although it depends on the services that they offer. They also don't always report to the same types of regulatory bodies that banks and credit unions do as it comes to deposits and loans. So just keep that in mind. Again, banks are for-profit institutions, and they are licensed through the federal government and regulated through the federal government to provide deposits and loans for their customers. Credit unions do pretty much the same thing, but they have a slightly different governing body, and they are member-owned and operated. They have members, not customers. So both banks and credit unions, which is what we'll focus on during this presentation, they accept cash, checks, and wire transfer deposits. They do provide loans, traveler's checks, although I'm not sure who uses traveler's checks anymore, foreign currency, and money orders, and they have a lot of conveniences, both credit unions and banks do, including online banking, ATMs, debit credit cards, many types of interest-bearing accounts, loans, things like that. They also offer insurance for deposits on certain types of accounts, up to $250,000 per account per person. So this says $250,000 per person. So keep that in mind. Banks and credit unions are both insured for deposits. And I'll focus a little bit now on some specific differences between banks and credit unions. Again, banks are for-profit businesses that make money from account fees and interest from loans. I'm going to revisit that in a moment for both banks and credit unions, because both banks and credit unions do earn money that way. Banks may have more convenient locations in the area or across the nation. Some larger banks may be international. You might be able to find an ATM for your bank that you have down the street in Roanoke if you travel internationally. Sometimes they have literally hundreds or even thousands of branches or ATMs out there as a resource. A lot of times banks, especially larger banks, will have a lot of convenient locations and services because of the resources that they can bring to bear on that. So banks have, it depends on the bank, but larger banks typically have more convenient locations. Also, banks are open to all. If you want to have a bank account, you just go and meet the minimum requirements of the bank account itself. And anybody who's eligible, anybody who can do that is eligible to apply and join. You don't have to be qualified in any way. Basically, it's offering a service, sort of like any business might offer a service or a product, and you can't be denied because of any type of qualification outside of regular financial guidelines that they would have for an account. A credit union is a not-for-profit business. It's not the same as a nonprofit again, but it's not-for-profit, and credit unions are required to share profits with membership. So we call our customers, quote-unquote, members, and that means that they actually own shares in our organization, and that a member of a credit union is going to receive share of profits in some format. Now, that doesn't mean directly dividends, although sometimes you see that. Share profits that come from credit unions are often distributed to members through either some sort of financial benefit, maybe better interest rates on loans, or maybe higher interest rates on savings products, something like that. But also, credit unions can share profits through offering specific financial services, or, for example, financial education, or some type of other extra that you get by being a member of the credit union. So the costs that we accrue for those types of services may also be considered sharing of profits. Credit unions also require membership in a community or a group to qualify, and that depends on a lot of different things. So as varied as there are credit unions is as varied as the community or group that you must be a part of to qualify to be a member. A lot of times it has to do with where you live, where you work, where you worship, go to school, or volunteer. Those types of things can be ways to qualify for a credit union. Not everybody does qualify for credit union, for every credit union. So as you are exploring maybe banking options with credit unions and with banks, and I would always encourage you to explore as many options as you can, If you're considering credit union membership, then you must qualify in some way, and you can talk to the credit union about that. It says here may offer better interest rates and lower accounting fees. That's true, but it's may. It's not always the case. And this is another thing I want to let people know. Sometimes people assume that one or the other is going to offer a better deal for some product or service. But I want to encourage you guys as business leaders and people who are interested in business to genuinely shop around for whatever best rate you can find, because those small percentage numbers can add up to big dollars over time. And I would encourage you to shop credit unions, banks, or any other financial institutions for that matter, to make sure that your business is getting the absolute best deal. It's part of being a business leader, is making the decision to either get loans or put your money into a banking institution that's going to be the best deal for your business. It says that credit unions also are typically smaller in size than banks, and they have usually fewer locations. That's typically true. It's not necessarily true or necessarily comparable with some smaller banks, but larger banks typically have, like I said earlier, many branches, and they can be either even statewide, national, international. They can be very large and have a lot of resources. Credit unions are typically smaller. Even the largest of credit unions have very low asset size as compared to large banks. So whenever you're working with credit unions, you have to be aware that they're going to be smaller entities usually in terms of asset size, and they're usually going to be more local. It doesn't always have to be the case that it's going to be more local, especially with the digital revolutions that are happening everywhere. But credit unions are usually smaller, usually have fewer locations for branches, and they usually have smaller assets. So just so you know. So that's the main differences between banks and credit unions I want to share with you. And then the last thing I want to share with you in this quick talk for food for conversation is to ask a simple question: how do banks make money, or how do credit unions make money? And there are lots of different ways actually that credit unions and banks can make money, but I want to zoom in right here on this line. It says that from account fees and interest from loans. We're going to talk about those two as the primary way. Banks and credit unions can also make money through fees for various services or providing other products that can be sold, or even through investments, things like that. But the primary way that most banks and credit unions earn money is through interest. And they move money, and they actually lend money in order to get that interest on loans, and they charge fees for account fees or other financial services that they offer. So a simple example for the fees, usually fees actually are less income than the interest that most banks or credit unions will receive on their loans. But fees can be something, for example, you might have a printed statement delivered to your house every month, and you might receive a small fee for that. So that's a financial service that a bank or credit union might charge you for a financial fee or an account fee. Also very common are things like overdraft fees, or fees that are about late payments, or some other type of fee. Whenever you sign up for an account or make an agreement, make sure you're looking carefully at the fees. Even banks and credit unions can charge for businesses, especially transaction fees, so individual fees for transactions. You want to shop around to make sure you're getting the best deal on that as well. The interest from loans, though, is the one that most people probably understand, because they are the ones paying back their loans. So you get a loan, and then as you pay it back, you actually pay a little bit more, and that's called interest. I don't have time to break down the whole formula, but that's how it works. Banks basically take in deposits from individuals or from businesses, and then they don't keep the money necessarily in the bank or the credit union. They then lend out that money at a higher interest rate, hopefully, than they are actually paying for that deposit. When I say hopefully, that means if they're working toward that profit model. So, for example, an individual might deposit, let's say, $10,000 into a savings product in either a credit union or a bank, and they might be receiving, let's say, 4% interest. Okay, so then the credit union or the bank will take that money, and it won't just sit there. They'll lend it out to someone else, and they may charge 7% interest, for example, on that same amount of money. So the spread there, the 3% between 4 and 7, becomes the earned interest on the money or the profit that the bank or credit union would make from that money. So that's how they earn their money. So basically, the idea there is to be aware that banks and credit unions are trying to earn money, and they have a slightly different structure in the way that they do that, but they do earn money. And so because they offer certain financial services, as a business owner or business leader, your business will be paying money to banks and credit unions if you are participating in their services. So the takeaway can be that banks and credit unions earn money in certain ways. And what I want you to take away from this is that you have the opportunity as a business leader to actually make choices when it comes to your banking. So you can shop for the best deals for you. And that sometimes includes the numbers themselves. Sometimes it's a combination between the interest and the fees, so be aware of that. Also, it's about the relationship too that you might have for that entity. Maybe your values are a little bit more local for banks or credit unions. Maybe you want those convenient services of banks and credit unions that are larger. So you get to shop for that. It's just like shopping for anything for your business. You want to get the best deal so that hopefully your bottom line is increased and you can have a stable business in our area. So thanks again. I am honored once again to be a part of this, and I hope to see you at the event. Please feel free to say hello, and we'll have a good conversation. Appreciate you. Goodbye.